Actually, quickly look at the rallying auto stocks as well, right? I mean, the back of likely GST rejig. Our colleague Sudarshan caught up with Shenu Agarwal, Managing Director and CEO at Ashok Leyland, to discuss the impact of GST rationalization on the first quarter performance. Listen in to excerpts out of that conversation.
I think if the GST rate cut happens, the CV industry would probably fall into the 18% category, which is a 10% reduction from the current rate of 28%. We really think that this would be a landmark reform in many different ways. First, it's overall going to spur a lot of economy, especially consumption, and therefore it would be better for the CV industry because there would be more freight to carry. And secondly, it will have a direct impact in terms of affordability of the trucks and buses. You know, the prices will go down. Also, we are hearing, other than GST, that there is some action that RBI is contemplating to increase the credit supply and credit access for the automobile sector. I think if these both can happen simultaneously, of course, we have to wait to get a confirmation and more details about this. I think that would be really a boon for the CV industry. As we know that, we have been waiting for a trigger like this because we know that the aging of the fleet is at its all-time high. So maybe this can come as a big trigger for onset of a positive cycle.
So if both these things happen, RBI action that you have talked about and GST rate cut, can we see an increase in the outlook, CV outlook, industry outlook for FY26 that currently you have for mid-single-digit growth outlook that you have for the industry?
I think so. I think it will have an immediate impact, and it will have a substantial impact as well. And therefore, the outlook of the CV industry for this year and the next year should improve from here on if it happens.
Great. Now coming to Q1 earnings. So you have literally outperformed the industry, especially on the volume front. Your profit too has seen an expansion of 13%. Revenue has grown by 2%. I remember when we were chatting after Q4 earnings, you had told me that Q1 might be slightly muted, but you have done better, especially on the margin front. You have done 11.7%, and that is almost 50 basis points expansion that what you have reported overall for FY25. So I know that medium-term guidance for margin that you have is of 15% or a little more than that. What is the margin range that you would be working for this fiscal, or if I can say FY26 and FY27?
Listen, we are very happy with the Q1 results. Of course, this was seemingly a tougher quarter with a lot of pressure from the commodity side. Also, the market last year, as you would recall, Q1 had a growth of about 5% in MHCV. And therefore, we were a little worried about how the market itself would perform. But I think despite all these uncertainties and the geopolitical situations, the commodity situation, I think we have done a good job in Q1. We have been able to raise our EBITDA by 50 basis points. And also simultaneously, we have increased our market share both in MHCV and in LCV segments. So it's a satisfying quarter. Going ahead, our mantra remains the same, that we want to gun for profitable growth. There is nothing like if we can achieve both the increase in market share and profitability, because I think these will, in our case at least, these will come from different levers. But from a market side, the industry side, we are also optimistic because Q2 last year was a very low base because, as you would recall, the CV industry grew by about 14 or 15% last year in Q2. And therefore, in Q2, at least we are operating on a low base. So I think there are good times to come for the industry. And of course, we'll try to do better than the industry.
So what is the current market share for M&HCV and LCV? And if you can talk about what was the gain in the market share that you have seen in Q1?
Yeah, so Q1 gain in market share was 1.3% in MHCV. Actually, in the truck segment, we have gained even more, which is to the level of 1.8%. We had a little bit of a market share loss in the buses, but that is not really concerning because we know the specific reasons for that. There has been a sudden shift in the demand of the fully built buses, and therefore, our whole capacity was completely choked as far as buses are concerned. We are ramping up our capacity on the buses in short term and also in the medium and long run. So we will will cover that loss in the buses, but we are very happy that in the MHCV truck business, we have gained 1.8% market share. The story is similar in the LCV segment. LCV, we are now reporting 0 to 7.5 ton segment because we have talked in the recent past that we want to focus on the entire LCV segment from 0 to 7.5 ton and no more just 2 to 3.5 ton or 2 to 4 ton. So that change has to come in internally as a measure also. But in overall LCV 0 to 7.5 ton, we have also gained 1.2% market share.
This export business that you continue to do well, even in Q1, you have seen a growth of 29% despite this like geopolitical tensions and all these tariff tantrums. How do you see this 29% growth that like, what kind of growth range that you'd be looking for FY26? Do you think that like you'll be able to maintain this 29 to 30% range?
Listen, our exports target for the year, for the whole year is roughly growing it by 20 to 25% in terms of volumes. I think with Q1 growing at 29%, that really helps us in achieving that overall year target. We are not still upping our target. We still want to gun for that 20 to 25% growth for the year. But yes, Q1 was good, and therefore it emboldens our ambition in exports to some extent.